I started my career like 18 years ago. I started as a prop trader on long-short equity for a French bank, Société Générale in Paris, where I spent like 7 years. First more on statistical arbitrage, like long-short equity, risk arbitrage type of deals. And by the end of my career, we started to sell our trading strategies outside of the bank. I would say there are three main partners. There is Laurent Plat and myself. So we started our career together at Société Générale. So Laurent was heading the quant research. I was on the trading side. So we developed models together, investment strategies together, and we kept working almost all those past 18 years together. And we created the strategies at BNP Paribas before. And the other partner come from Deutsche Bank, where he spent many years, more than 10 years, actually developing a methodology to transform accounting data before creating his own research company. So in a way, we have mixed two technologies, one that we developed at BNP Paribas with my partner Laurent, and the other one which was about transforming accounting data. So for us, technology, big data was a very big opportunity, not to do something different, but to do something that has been working for many years to invest in stocks, but in a greater magnitude. So the idea is that we try to do something very well, which was done for 100 names before, on thousands of names. So we process many data, and on many stocks all over the globe to select the very best companies. The first thing is to recognize who have been the investment champions. So we don't think by ourselves that we could reinvent investing. So our point is, who are the Olympic champions, world champions of investment for the past century? So what we did, we recognized the best track record, so obviously Warren Buffett, Benjamin Graham, Peter Lynch, the greatest investors of all times, and we raised a very simple question. Are those people geniuses? So that for us it was over, we could not do anything. Or are those people thinking investment in always the similar way, in a systematic way? So we bought all the books, all the research that we could get from those people, and with our quant tools, we tried to retest what they were saying or writing in the book. And we came up with some kind of best of methodology, the best practices of those investment goals. It's bottom-up. They want three things. The first thing, they want a company which generates cash. A company which has proven its capacity to generate maximum cash out of operations. That's the first thing. The second thing is that you invest today, but you are exposed for the future. So you want to ensure that the company which is profitable today will remain profitable for some time. But once you have that, you don't have yet a good investment, because this company, which is both profitable with a good future, you want to buy it at a relatively cheap price. The way we select the stocks is very systematic. So we always do the same. Would it be for our US fund, our European fund, or our global fund? So we don't think you should treat differently investment opportunities depending on the region. So the way we do it, every month we give scores on profitability, prospects, and valuation. First is psychology. We don't get emotional. We define rules. We want to be very clear about the rules to get strong confidence that the rules that we apply are good, and then we apply them, whatever the situation, the macroeconomy, interest rates, inflation, we stick to the rules. Unlike traditional managers, we process many more data, many more situations, and by doing so, we just create more opportunities. So we may have more opportunities than a traditional manager. We manage 4 funds, 3 equity funds, exactly the same technology, simply different regions. So we have one US fund, trying to be the average US market, one European fund, so same thing for the global European market, and we have one global fund. So the global fund is like independent of the two other funds. So we look for around 3,000 companies globally from Japan to the US, emerging to developed Europe, South Africa, so all over the world, as long as the companies are liquid.